Welcome to Financial Clarity Club, where we demystify the complex world of finance and cryptocurrency. Governments worldwide are actively developing their own digital currencies, known as central bank digital currencies or CBDCs. Unlike decentralized cryptocurrencies such as Bitcoin, CBDCs are fully centralized and controlled by a country's central bank. They promise fast and efficient transactions, but this comes with significant trade-offs regarding privacy and control. So what exactly is a CBDC? It's a digital form of a country's fiat currency, issued and regulated directly by its central bank. Think of it as digital cash. It behaves like physical currency, but exists entirely online, a direct liability of the central bank. This means you might one day hold your dollars, euros, or rupees directly in a government-backed digital wallet. CBDCs are designed to complement, not replace, traditional cash, aiming to provide stability and integrate with existing financial systems. Governments are exploring CBDCs for several compelling reasons, driven by the potential for economic and social benefits. Firstly, CBDCs can significantly reduce transaction costs by eliminating intermediaries like commercial banks and payment processors. They also enable instant payments and settlements, including faster cross-border transactions, boosting efficiency. Financial inclusion is another key driver, as CBDCs can provide access to financial services for in-bank populations. This allows them to receive payments, hold money, and pay bills without needing a traditional bank account. Furthermore, CBDCs offer governments more direct control over monetary policy during economic crises, allowing for targeted interventions. Finally, CBDCs can enhance the transparency and traceability of transactions, making it harder for illegal activities like money laundering. This makes CBDCs a form of programmable money, which can be both a powerful tool and a potential concern. Now, let's clarify the differences between CBDCs and stablecoins, as they are often confused but operate very differently. Stablecoins typically live on decentralized blockchains, offering transparency and often backed by reserves. CBDCs, however, reside on government-controlled networks, meaning they are centralized and regulated by central authorities. While stablecoins aim for transparency through their underlying blockchain, CBDCs prioritize efficiency. This efficiency often comes at the cost of privacy, as government-controlled systems can potentially monitor all transactions. Stablecoins are typically issued by private organizations, while CBDCs are issued directly by central banks. Their stability mechanisms also differ. CBDCs maintain a stable value relative to the national currency, similar to cash. Stablecoins, while aiming for stability, may fluctuate based on their backing and market demand. Let's weigh the advantages and disadvantages of CBDCs to understand their full impact. On the positive side, CBDCs enable instant payments, significantly reducing settlement times and improving overall efficiency. They also promise lower fees by cutting out intermediaries, making transactions more affordable for everyone. Financial inclusion is a major benefit, extending digital payment access to in-bank populations and promoting economic participation. However, there are significant concerns. Potential surveillance is a primary worry, as governments could monitor all transactions. This leads to less privacy for individuals, as anonymity in financial transactions could be greatly reduced. Another concern is the potential for government control over spending behavior, raising questions about individual financial freedom. Cybersecurity threats are also a risk, as centralized CBDC systems could be vulnerable to hacking and data breaches. Finally, CBDCs could lead to financial disintermediation, potentially reducing the role of traditional banks. CBDCs are poised to reshape the global financial system, even if they don't directly replace decentralized cryptocurrencies like Bitcoin. They represent a modernization of payments, promising increased efficiency and new tools for monetary policy. The push for financial inclusion through CBDCs could bring millions into the digital economy, fostering broader economic participation. However, the increased transparency and traceability of transactions also raise critical questions about privacy and government control. The design and implementation of CBDCs will ultimately determine whether they benefit society or introduce new risks to financial freedom. Digital money is undeniably coming, but it's crucial to understand that not all digital money is decentralized. Thank you for watching. Subscribe to Financial Clarity Club for more insights into crypto and finance.